Imagine this. You walk into the grocery store, pick up your usual basket of essentials, and when you get to the checkout, the total is higher than last month, even though you didn't buy anything extra. Now, multiply that feeling across millions of American households, and you begin to understand what's happening in the economy right now. On the surface, consumer spending looks strong. People are still shopping, still paying bills, still filling up their cars. But when you peel back the layers, a more complicated picture emerges. One that raises big questions about how long this momentum can last, and who is actually able to keep up. In August, Americans boosted their spending by 0.6%. After adjusting for inflation, that increase comes out to about 0.4%, which shows that consumer activity remains one of the strongest forces keeping the economy afloat. That might sound reassuring at first, but here's the twist. Much of this spending is not on fun or optional items. It's on essentials, things like healthcare, food, electricity, and housing. Categories people can't easily cut back on, no matter how much prices rise. And those prices did rise, according to the government's latest Personal Consumption Expenditures Report. The PCE Price Index, the Federal Reserve's preferred measure of inflation, ticked up 0.3% in August, lifting the annual rate to 2.7%. Core PCE, which excludes food and energy because they can swing sharply, rose 0.2%, staying at 2.9% annually. That may sound like small numbers, but they matter enormously because they show inflation still running above the Fed's 2% target. Food costs climbed 0.5% in a single month. Energy costs, from gas to utilities, pushed higher too. Over the past year, beef and veal prices are up nearly 14%. Household utilities are up 7%. Electricity costs are up more than 6%. These increases don't just dent wallets. They reshape how families plan their budgets, month after month. And here's where things start to get more unsettling. While the headlines suggest resilience, not every household is experiencing the same reality. Economists call this a K-shaped economy. The idea is simple. When you chart the recovery, some households move upward, building wealth, while others slope downward, feeling more strain. In fact, data show that the top 20% of earners account for about half of all spending in the economy right now. That means a small share of households is powering a disproportionate amount of activity, while many others are struggling just to keep pace with rising costs. It's a split reality, one that can't be seen just by looking at national spending totals. For many Americans, the only way to maintain current spending levels has been to dip into savings. In August, the savings rate fell to 4.6%, down from 4.8% the month before. That might not sound dramatic, but it reflects a broader trend. Income growth isn't keeping up with price increases. Personal income rose 0.4% in August, but once adjusted for inflation, the increase was just 0.1%. On an annual basis, after-tax income is growing at 1.9%, while real spending is growing at 2.7%. The gap between income and spending is being bridged by savings accounts that, over time, can only stretch so far. Think about what that means for the everyday consumer. More money is flowing to healthcare, insurance, rent, and utility bills, obligations people can't avoid. In fact, as of August, nearly 23% of consumer spending was directed toward healthcare alone, and about half of that comes from Medicare and Medicaid programs. When so much of the household budget is consumed by essentials, there's less room left for discretionary purchases. The meals out, the vacations, the clothing, and the gadgets. Those may sound optional, but they're exactly the categories that drive sales for countless businesses, from restaurants to airlines to retailers. Here's the ripple effect. When discretionary spending slows, the businesses that rely on it start to feel the pinch. Some of them tighten budgets, cut staff, or close locations. One example is Starbucks, which recently announced it will close about 400 underperforming stores nationwide. That's just 1% of its footprint, but it involves nearly 900 job cuts. While that's only one company, it illustrates a pattern that could become more common if consumers continue to scale back on non-essential purchases. And when businesses shrink operations, the cycle feeds back into the labor market, potentially creating more pressure on households already struggling. If you're finding this breakdown useful so far, make sure to hit that subscribe button so you don't miss future updates. We bring you clear, data-driven insights without the noise. Now, let's talk about another important dimension: consumer confidence. Numbers on spending and inflation tell us what's happening, but surveys on sentiment tell us how people feel about it, and feelings influence behavior. According to the University of Michigan's latest survey, consumer sentiment remains near historic lows. To put that into context, analysts say you have to go back to the Great Recession to find vibes this pessimistic. And here's the kicker: that drop in confidence is showing up across demographics, cutting across age, income, and background. The one group holding up better? People with larger stock portfolios, who are somewhat shielded by rising markets. That matters because stock performance can diverge from lived experience. While the Dow gained about 200 points in response to the August spending report, and the S&P 500 Nasdaq also ticked higher, stock gains don't translate into relief for households that don't have significant investments. In fact, the more markets rise, the larger the wealth gap can appear, further amplifying the sense of a divided economy. So what happens next? The story isn't all doom and gloom, but it is complex. On one hand, aggregate spending remains positive, showing that the economy hasn't stalled. On the other hand, the foundation of that spending, shrinking savings, slower income growth, and growing reliance on higher earners, is not sustainable forever. If households continue to shift more and more toward mandatory expenses, businesses in the discretionary sector will face greater challenges, and that could ripple outward into employment trends. Economists are watching closely to see whether inflation continues to cool or stays sticky, especially in services. They're also tracking whether consumers can rebuild savings or whether they continue to draw them down. Every percentage point matters. A slight shift in gas prices, food costs, or utility bills can change household budgets nationwide, altering spending patterns in ways that ripple across the broader economy. And here's where the gap theory becomes especially clear. The headlines may suggest strength, but the lived experience is more nuanced. Some households are weathering this period just fine. Others feel like they're walking a financial tightrope. Both realities exist at the same time. And which one you fall on, it depends heavily on your income, your savings cushion, and whether you're exposed to rising costs in categories like food, utilities, and healthcare. That divide, visible in the numbers and in the sentiment surveys, will shape the trajectory of the economy in the months ahead. So the next time you hear that consumer spending is strong, pause and ask, strong for whom? Because the answer to that question will determine how resilient this economy really is and how prepared it is for the next shock. Stay tuned. And, as always, we'll keep bringing you the insights you need to make sense of the numbers behind the headlines.